So, what if you could read the story of a market's next move just by looking at a chart? Well, that's exactly what we're going to get into today. We're going to decode the language of trading patterns. If you've ever looked at a price chart and just felt lost, like you're staring at a secret code, you are definitely not alone. It can feel totally random, right? Just a bunch of overwhelming squiggles. But here's the secret. There is a language to these charts, and the key to cracking that code, to really understanding the story they're telling, is learning to spot their patterns. So, what is a trading pattern, really? Well, simply put, it's just a recognizable shape that pops up on a price chart. And these shapes, they're not random. The idea is that they're statistically significant formations that can give us a clue, a little heads up about where the market might be heading. And this is where it gets really cool. Think of each pattern as a visual story. It's like you're watching the collective mindset of the market play out in real time. That constant tug of war, that big battle between the buyers, who are trying to push prices up, and the sellers, who are trying to drag them down. Okay, so to keep things simple, we can pretty much group every single pattern out there into just two basic categories. Each one tells a very different story, either the story of continuation or the story of reversal. So let's break that down. A continuation pattern, that's your signal that a trend is probably just taking a breather and is likely going to keep going on its journey. But a reversal pattern, that's a totally different story. That one's telling you the trend might be running out of steam, getting tired, and could be about to change direction completely. All right, so let's dive into that first story, the one where the trend is just pausing, not stopping. We're talking about continuation patterns. And for this, we've got to look at a classic example, the flag. Honestly, it's one of the most common and easiest to spot continuation signals you're ever going to find. So how do you spot one? Well, first you get this really strong, sharp move, either up or down. We call that the flagpole. Then, right after that, the price kind of settles down into the small, neat little rectangle that slopes just a bit against that first big move. That little rectangle, that's the flag. All it really represents is a quick pause, maybe some people taking profits, before boom, the trend is expected to kick back in and continue with some real force. Okay, so that's continuation. Now for the second major story, reversal patterns. These are the big ones, the signals that an old trend might be dying out and a brand new one could be just around the corner. And a perfect example of a reversal is the double top. The easiest way to remember this one, just think of the letter M. It's got that distinct M shape, and you'll usually see it pop up right at the peak of an uptrend. So what's this M shape actually telling us? Well, it shows that buyers tried to push the price to a new high, and they failed. The price pulled back, and then they tried again, one more time, only to fail at that exact same level. That second failure is everything. It's a huge sign that the buyers have lost their mojo and the sellers are starting to take charge. Now, the pattern isn't official, it's not confirmed until the price breaks below that little valley between the two peaks. We call that the neckline. And hey, as you can probably guess, there's an opposite to this pattern. It's called the double bottom. So if the double top is an M, the double bottom is a W, and you'll find it at the bottom of a downtrend. This W shape tells the exact opposite story. Here, the sellers try to push the price to a new low, and they fail. After a little bounce, they try again, but the buyers step in and defend that same support level. This double rejection is a really clear sign that momentum has shifted away from the sellers and over to the buyers. And just like the double top, it's only confirmed when the price breaks above its neckline. Okay, so spotting these patterns is one thing, but actually trading them effectively, that's a whole other ballgame. It's not enough to just see an M or a W on the chart. You have got to have a disciplined approach. It is absolutely essential. And that brings me to something super important, a point worth really hammering home. Every chart pattern can give you a false signal. A pattern can look absolutely perfect, textbook perfect, and then just completely fall apart. And that's exactly why confirmation and managing your risk are, well, they're non-negotiable. So how can you tell if a breakout is the real deal? Well, there are three key things to look for. First, check the volume. A real breakout should come with a big spike in trading volume. That suggests there's real power, real conviction behind the move. Second, look for a strong candle. You want to see a nice, full-bodied candle that closes clearly and decisively outside of the pattern. And third, this one's optional, but it's a really powerful sign. Watch for a retest. That's when the price comes back to kind of kiss the level it just broke before taking off again. Okay, so once you feel like you have confirmation, you absolutely need a plan. Here it is, a simple three-parter. Step 1, plan your entry. Know exactly where you're getting in. Step 2, and this is probably the most important, set your stop loss. Put it at a logical spot where the pattern would basically be proven wrong, like just above the peaks of a double top. And step 3, define your profit target. A really common way to do this is to measure the height of the pattern itself and then project that distance up from the breakout point. All right, as we start to wrap this up, I really want to drive home the right way to think about these patterns. This is all about probability, not prophecy. It's about tilting the odds in your favor, not trying to predict the future with 100% certainty. So let's recap the keys here. Number 1, patterns are tools for weighing probabilities. They are not crystal balls. Number 2, while you can find these patterns on any time frame, they are generally much more reliable on the higher ones, like the daily or the weekly charts. And finally, number 3, your odds of success go way, way up when you combine these patterns with other tools, like the volume indicator we talked about earlier. And you know, this whole field is always evolving. It's pretty wild to think that today there's sophisticated AI being used to spot these exact same patterns, these same fingerprints of market psychology across thousands of markets, all in real time. We're talking about a speed and a precision that the human eye just can't compete with. Because at the end of the day, that's all a pattern is, a footprint left behind by the crowd. It's a visual record of a timeless story, a story of fear, of greed, of indecision. So the real question is, now that you're starting to learn the language, what story are you going to read next?